I'm Jenny Brown. Welcome to this week's MFB News. I hope everybody is really well. You've had a wonderful week and life has been very kind. So what have we got for you this week? We've got an update on what's been happening with the mortgage rates and the mortgage market, just filling you in there. The good news is that things haven't got any worse. So from the previous couple of weeks, so there's the positives, and I'm just going to be letting you know of some changes that have been happening and what's looking more and more likely to happen going forwards with mortgage products. We're then going to have a chat about product transfers. These are going to become more and more key to mortgage borrowers as the rental calculations have moved on, and so stress test rental calculations are not working for every borrower. So we're going to talk a bit about product transfers, which could be a bit of a lifesaver for you. And then lastly, I'm just going to give you an update on what's been happening in the property market with the latest news release from RICS. So first up, in terms of mortgage products and what's been happening, so it's actually been a really quiet week in terms of pricing changes. I think a lot of the lenders are just really now sitting, watching the money markets and waiting to see how things shake out. Now, you all remember from previous videos, we talked a lot about swap rates because these are largely what drive the cost of fixed rate borrowing. Last week, they were sitting at high fours. Over the course of the last week, they've kind of gone back up again to 5.1. 5.115 was the peak yesterday, but they've actually eased. So at 10:30 last night, they've gone back down to 4.86%. Now, this could be on the back of the news of Kwasi Kwarteng's emergency kind of rush back from the IMF meeting. It could be that markets are waiting for him to announce a reversal of the planned tax cuts. I mean, who knows at the moment. I should just kind of timestamp this video. It's 7:30 on Friday morning, Friday the 14th of October. So it's very early in the day. So by the time you're watching this, things could have moved on. But actually, the swap rates did ease back down a little bit last night, but not life-changingly so. So yeah, the lenders are really just kind of sitting and watching the market at the moment. We have seen a couple of lenders come back in. So we saw the Suffolk relaunch into buy-to-lets and holiday lets. We've seen Aldermore return with some products. They start with a 7, so we're not going to go into those in too much detail at all. But it's great to see them back. So we've largely got, I would say, pretty much a full complement of lenders back offering 5-year and 2-year fixed rates now, which is really wonderful. But like I say, the pricing probably feels more or higher than most people are comfortable. It's interesting, I've spent a lot of time with landlords this week actually. I was very privileged to attend the iHouse and NRLA annual meeting in Dover, and I sat with lots of landlords there, and it was really interesting to hear what they're worried about and what they're kind of thinking. The general sense that we're getting from investors at the moment is if they can get an interest rate that kind of starts with a 5, even a low 6, at an absolute push, but really, starting with a 5 is kind of, preferred. I think most landlords are saying that they can kind of keep things on track. The rents will cover the mortgage payments, and they're going to be all right. It's when the rates starting with a 7, they start to feel incredibly uncomfortable, unless you're looking at more like HMOs, multi-units, those higher yielding assets. So look, one of the things that I just wanted to touch on for you today, because we're seeing more and more people now looking at variable type mortgage products, so discounted and tracker rates. And I just wanted to, because we haven't really talked about these because fixed rates have just been so incredibly popular for years now. So with more and more people now considering the variable type products, because these kind of come with the lower rates at the moment, I just wanted to talk a bit about the different types of variable rate mortgages that you will find. So as we know with variable rate mortgages, the rate of interest is variable, so it can go up and down in line with whatever interest rates are doing in the market. There are 2 real types of variable type products available. Those that are tracking Bank of England base rate, and those which are going to be a discount off the lender's standard variable rate. And I think it's really important to kind of just go through the differences of these 2 products. So a product that tracks the Bank of England base rate does exactly that, and the wording you would expect to see is base rate plus 1.5% for 2 years, 5 years, the term of the mortgage, whatever that is. But essentially, if base rate were to go up by 0.5%, instantly your mortgage rate goes up by 0.5% with it. And likewise, if mortgage rates go down by 0.5%, yours would just simply follow suit. So it's literally just following base rate at a margin. Now, some people prefer borrowing against base rate trackers because there's a kind of sense of trust, I think, amongst the the population, which is understandable. So the Bank of England, it's a kind of institution that we all understand. We see it as a very kind of legitimate, almost fair kind of institution. We've got trust in it. So we feel that anything that's tracking the Bank of England base rate means that we're not going to kind of pay unfair interest rates, that kind of thing. The risk is, I suppose, that actually your mortgage rates will simply just go up if Bank of England base rate moves up. Now, conversely to that, so we look at discounted rates now. So a discounted rate is where the lender is offering a discount off their own standard variable rate. So each lender has a standard variable rate, and you would know this as the rate of interest you move on to when your fixed rate finishes. And so lenders will offer you a discount off of that standard variable rate. So standard variable rates at the moment are sitting at around between 5.5% and 8.5%. So the lender would be saying, we will offer you a discount of 2% or 2.5% or whatever the rate is. And so whatever their standard variable rate is, just like with the base rate trackers, your rate will simply just follow that interest rate with the same margin. And again, you can have discounted rates for 2 years, 3, 5, 10, 25 years. There's all the kind of very options there. So I guess the difference with a discounted rate where you're looking at lender's standard variable rate is that the lenders, there's no kind of set rule in terms of what they can or cannot charge for their standard variable rate. So I think some people always feel quite uneasy. What if the lender was to push their standard variable rate up really, really high? What's to stop them doing this? And the very short answer is largely, for most institutions, there isn't a huge amount to stop them doing this. But what we have found, and if you look at the data over time, most lenders' standard variable rates do tend to follow as a kind of pattern base rate. However, with the standard variable rates, they're not necessarily directly linked to base rate. So if base rate went up by 0.5%, your standard variable rate might also go up by 0.5%. It could go up by 0.75%. It might not go up at all. It really does vary. So there's a lot more kind of flexibility. And what we're finding at the moment is the standard variable rates are not necessarily jumping up at the same level of base rate. So actually, in some circumstances, those people who are currently on a rate which is linked to a lender's standard variable rate rather than base rate have actually done a bit better. They've had less of an increase. Now, the other kind of misnomer on these variable products actually is that people always assume they come without any early repayment charges, and that's not true. Now, there are variable rate products and tracker rate products without any early repayment charges, but actually the majority of them do have ERC. So if you are looking at these with a kind of view of, I'll just take one of these for now, but actually once things cool down again in a year's time or however long it might be, I'll then jump onto another fixed rate. Do just check the small print and make sure that there's no early repayment charges attached to the variable rate product you're looking at. So I hope that's helpful. So look, in terms of where pricing sits in the market now, we like to do a roundup every week so you can kind of get a reset on pricing. So if we're looking at personal mortgages, first of all, so discounted rates, a discount off lender's standard variable rate, currently from 2.79. The lowest variable rate I've got tracking base is currently at 3.14, that's for 2 years. I've got a product which tracks base for term, or products that track base rate for term of the mortgage. They're now from 3.9%. 2-year fixed rates from 4.2 and 5-year from 4.83. Moving into the specialist end of the market now, so limited companies. So your lowest discounted rates are from 3.99. Your lowest base rate trackers are from 4.69%. Base rate for term, 3.9%. 2-year fixes from 5.09 and 5-year fixes from 6.04. Now, in terms of what we're thinking is going to happen over the coming few weeks, it's really hard to gauge. My suspicion is that actually we may see a reversal of sorts of the tax cuts. That will hopefully appease the markets, and we might see swap rates come down a bit. Now, what's been interesting is when we've been talking, Pete, to some people, they've been saying, I'm just going to wait. I'm just going to wait this out because actually, I think rates are going to come back down again, and I'm hoping to be able to get a rate that's kind of more akin to what I could have got in spring of this year. Now, the reality is that simply isn't going to happen. So even before the mini budget, 5-year swap rates were sitting at around 4%, and that's been driven up by inflation and all the other things that are kind of in the mix at the moment in the ether. But what we didn't see was swap rates at sort of 2%. So if you cast your minds back to the kind of rule that lenders who are borrowing through the money markets need to make circa a 2% to 2.5% margin on rates, even if we got swap rates down to sort of more like 4%, you're still looking at interest rates of at least 6%. So, I think just to kind of manage expectations, what we're not going to see is a reversal where we're able to take 5-year fixed rates at 2.99, and those kinds of levels, you are still going to be looking at things that start with at least a 5. Okay, so moving on to product transfers now. So these are going to be a really big thing going forwards. And we've seen a growing popularity in product transfers over the last few years. Now, a product transfer is essentially where you go back to your existing lender at the end of your mortgage deal and they simply offer you a new mortgage rate to stay with them. Now, historically, these haven't always been a very popular option because A, not every lender has offered them, and B, what we found is that the rates they would offer to existing borrowers were much less competitive than they were to those new borrowers they were trying to attract in as new lending business. So it's finally dawned on lenders, I think, God knows how it's taken this long, that actually it's actually very cost effective to retain a borrower for more years than it is to sort of be re-recruiting new borrowers every couple of years. So lenders are much more focused on product transfers now than they have been. That said, most lenders don't offer the same mortgage rates to existing borrowers as new borrowers, but what we found is that what they are offering has become much more competitive, much more kind of akin to what you would get as a new borrower. Now, in terms of which lenders are offering product transfers, like I say, not every lender has always offered these. Things have become much more open with regards to the amount of choice that's available here. There are still a handful of lenders who are unable to offer product transfers, but in the main, the vast majority do. So how it works when you apply for a product transfer is we literally go onto the lender's site, we will enter your mortgage account details and some other sort of information to get past security, and then what the lender's going to do is make an assumption about the value of the property. They're going to look at the amount of debt that you have, and then they're simply going to offer you a rate. And there tends to be, from most lenders, 2-year fixed, 3-5, and maybe some kind of variable option as well. And then what we can literally do is, on agreement with our clients, we show them the options, they pick a rate, and we then press a button, and the product transfer for most lenders simply kind of clicks in to take effect from when their existing deal ends. Now, the reason this is so important is that when we're looking at remortgages at the moment and the rental calculations, as I talked about last week, have become incredibly harsh because of the higher interest rates. Actually being able to obtain a new mortgage rate from your existing lender without having to go through those affordability checks again could be an absolute lifesaver. So if you are in a situation where you're coming to the end of your mortgage rate and you want to look at options, as a business here, what we always consider product transfers for our clients. I can't speak for every broker, but I think it should be really good practice for everybody to consider this. But like I say, it really is just worth considering these. So the pros of product transfers would be no underwriting, they're really, really quick, and actually you tend to avoid costs such as valuation fees and legal fees. Now, this isn't the case for all lenders, but it is the case for most lenders. The downside of product transfers would be that actually you're not shopping the whole market, you're not necessarily going to be getting the cheapest interest rate. So they're not going to be for everybody, but for some people, particularly those who are kind of stuck because of the rental calculations and can't go somewhere else, these are going to be absolutely invaluable going forwards. Now, we haven't talked about the property market for a few weeks, so I thought you'd be missing it and I'd go back to it. So RICS have published a little kind of report, and I just wanted to share some wording from this. So what they have said is that the property market is losing momentum as soaring interest rates and economic uncertainty stall buyer activity. They said that house prices were continuing to edge higher for now, although the pace of growth is easing noticeably across the country. In terms of demand, the number of inquiries from potential home buyers fell for a 5th month in a row in September, with sales at the lowest level seen since May 2020. The flow of new instructions to sell remained very much in decline, with 15% of RICS respondents saying they had seen a decline in fresh listings during August. Now, Simon Rubinson, who's the chief economist at RICS, said that storm clouds are visible in the deterioration of near-term expectations for both pricing and sales. The turmoil in the mortgage markets in recent weeks has compounded the increasing level of economic uncertainty resulting from higher energy bills and the wider cost of living crisis shifting the dial in the housing market. So, I think it won't come as a huge surprise to anybody that we're starting to see a slowdown. Interestingly, Savills published their report for what they're expecting house prices to do. So they had published one, they've revised it, and it was just very, very interesting to read. So essentially what they are predicting is that we're going to continue to see growth for the rest of this year. Moving into 2023, we are going to see a slight reduction in house prices. they're not talking 20%. I know I've heard this, I think, on the news, not 20%, it was kind of like more like 1.5%. Now, if you consider the gains that people have made in their property values over the last 12 to 18 months, and then you think about losing 1.5%, actually you're still way ahead of the game there, but they are expecting things to ease off slightly next year. But then actually return to growth. So when we're going forward over the coming few years, after 2023, they're expecting house prices to start going back up again. So I think actually, you know, in terms of for those landlords who've been waiting out the market because of the stamp duty kind of craziness that happened, gazumping and all the rest of it, and now they're kind of waiting to see what happens and how things shake out over this period of time and uncertainty that we're going through. Actually, I think there could be a really good opportunity for some landlords to come back to the table and start reinvesting. And that's everything for me this week. It's interesting, isn't it? I actually don't quite know what I'm going to be talking to you about next week, because it could be that we've had a massive U-turn on the tax cuts. You know, swap rates have eased back down, and suddenly I'm going to be shouting from the rooftops about how interest rates have all come down. It could also be that nothing's changed, and it could also go in the other direction, couldn't it? So let's hope for some positive news next week. However, you know, what I would also say is it's not all doom and gloom. So there are mortgage rates out there. Actually, when you look at some of, particularly in the personal space, you know, 5-year fixed rates at sub 5%, actually they're not that bad. I was reading a book about sort of the history of mortgages, because I am that tragic, and I was reading some historic adverts, which is from in the 90s, where people were shouting about the fact that they were selling a 5-year fix at 11.97% with no early repayment charges. So it just kind of puts things into context. Yes, it feels a lot more expensive than it has been, but it's not actually the most expensive it ever has been, and people survived during those very high interest rate periods, so we're all going to be okay. If you have any questions, do give me a call, 0345 345 6788, or have a look at our website, mortgagesforbusiness.co.uk. Any questions at all, we'd love to hear from you. Until next week, look after yourselves.